Hello everyone. This video relates to investment process. It's part of Unit 1, that is Introduction to Investment. So at first I'll be giving you an overall description of how investment process, what is the process of making an investment. So first is objective or goal setting. That is uh, to understand or to make an objective with which you are making an investment. Next is portfolio construction. That is trying to develop a portfolio, and the meaning of portfolio is combination of a mix of securities, number of assets on mix of securities in a particular time frame. That is a portfolio. So developing the foundation and framework for your portfolio. So you need to understand with what objective you have framed, and according to your objective you need to construct a portfolio. Next is implementation. That is executing your plan. Once you have constructed, once you have thought of what are the various securities that or assets that you want to put in the portfolio, then you buy or purchase those securities or assets. Next is portfolio monitoring and evaluation. That is taking care and trying to evaluate whether the portfolio that you have constructed, is it achieving the objectives that with which you have constructed your portfolio. So in detail, so suppose goal setting. So you're first of all you're trying to understand. Number one, that is goal setting. We're trying to understand uh, what do you want in future. Whether you are investing for 5 years, whether you are investing for 10 years, or whether are you investing for 1 year or 1 month. So it may be for various reasons with which a person or individual or investor may be making an investment. So there should be establishment of clear financial goal. So if you are investing to purchase a car within 2 years, then if you are making a fixed deposit for 5 years, that would not make sense because you need the car within 2 years. So you need to invest in such a platform or such an avenue whereby your investment is safe and it gives a return to the amount that you have invested already, so that you can buy a car within 2 years. So it should be very clear understanding of your objectives. As well, you need to prioritize your objectives. So you may have number of objectives, but you have to understand which is the most important as of now. Then you rank them. Suppose if buying a car is the most important, then you come your marriage, then you're building your house. So with the objective with which you are investing should be prioritized. Next is portfolio construction. So portfolio construction is a part whereby the investor tries to understand the market and tries to associate or bring a relationship between the objectives and the securities in the market. So it is divided in two parts, that is asset allocation and investment selection. So asset allocation determines how your investment assets are allocated across different classes like equities, bonds, cash or money market instruments, real estates, etc. So you need to understand what amount of money you need to allocate. What amount? Suppose you have rupees 1 lakh. How are you going to uh, make the investment or allocate your fund in different avenues? So that is asset allocation. So it is in relation to the basic objectives which we have already set. Then investment selection. So in this particular point, you select what are the various individual items that the investor is going to opt for from the abundant market or from the various markets in the across the world. So if you are thinking of equity market, then you have to select the particular equity share which you are going to purchase, or a number of equity shares. Suppose there are number of companies, like you have All India, you have ONGC, you have Reliance, you have Tata. So which equity share you are going to buy? So that is the investment selection part. Or in case of bond, which bond you are going to invest on. So that is investment selection. Then implementation of the entire portfolio or the entire construction or assets selection. So once asset allocation and investment selection decisions are done, it must be executed through purchase and sale of assets or securities. So once you have already selected that this should be the particular instrument or asset or security that you need to buy, then you need to execute it. That is, you are going to purchase that particular security, or if you have already if you already hold one security, you can sell it off. So that is the implementation part of the investment process. Then we move on to the portfolio monitoring and portfolio evaluation. So monitoring means you are trying to understand whether whether the portfolio that you have already constructed, has it or did it help achieve you the required objectives which you have set the portfolio. So any changes in the objective, risk tolerance, income, net worth or liquidity needs, or changes the entire portfolio. That is, if suppose if you are unmarried, now you are going to get married, then your objectives also become different. So thus you need to, from time to time, you need to evaluate whether you are having the same objectives or you are changing your objectives. Next we move on to the investment alternatives. So you see in this picture, there are a number of alternatives like equity shares, money market instruments, life insurance, precious objects, debentures, bonds, non-marketable securities like bank deposits, post office deposits, company deposits, mutual funds, real estates, derivatives. So in order to understand that, though, these are considered as categories of investment. So we have number of categories of number of types or investment alternatives. So some of them are listed here. Though, like one is variable income securities like equity shares, whereby it has weak it does not get any interest, but instead it gets the equity shareholder gets dividend. So that is a form of variable income security where the income may vary from time to time. And we have fixed income securities like bonds, debentures, where the interest rate is specifically mentioned. If you purchase or invest in a particular bond, if it is 6% interest rate, then throughout the maturity period, up to the maturity period, you are going to get the same amount of interest rate. Then we have deposits, like in this picture, you notice that there are deposits like bank deposits, like savings, term, recurring. Then we have post similarly, the same type of deposits are there with the post office. So there you can invest. Then we have tax sheltered investments. So tax sheltered investments may include certain deposits. Like then we also have NSC, like the National Savings Certificate, and we have PPF. So these are certain instruments through which you can invest and also get tax deductions. Then we have insurance, where insurance includes life insurance policies where you can invest now so that in a very long period of time you get a huge amount. Nowadays, not only insurance can be made for a longer period of time. Nowadays, shorter life insurance policies are also there, which are being termed by different names like Jivan Lav, Santosh. So there are various names to which you can invest for shorter period of time. Then we have mutual funds. We have open-ended mutual funds, close-ended mutual funds. So there are various mutual funds which exist and which can be a source of income in if the objective is to earn a better rate of interest. So most of the mutual funds, if you compare, it's better, or it gives a better rate of income than other sorts of categories of investment. Then we have hedge funds. So this is basically not very common in our common parlance. So it is basically related to investment which is very liquid, and it is basically done by institutional investors. We are not a very individual investors do not make a part of this particular investment generally. Then we have pension funds, like it's very compulsory for various organizations to contribute towards NP. Like we have National Pension Scheme. Not only there is National Pension Scheme, but there are other system or funds which are generated so that an individual can get a better life in after retirement. Then we have derivatives. Derivatives, we have like options, we have swaps, we have futures, forwards. These are a sort of instrument where the underlying value of the instrument signifies the value of the instrument. That is, these are very common in our country as well, where people, individuals also can make their investment. Then we have real estate. Real estate is land building, where you purchase land, where you purchase buildings, or you construct a building and lease it. So if you purchase a land, the amount of that particular price of the land may increase in future. Then we have precious metal like gold, diamond, where if you invest now, the price is expected to rise in future. So these are some sort of categories of investment which are there, or investment alternatives which are supposed to be invested by investors. Next, characteristics of investment. So there are basically five important items. It's risk factor, return, safety, income, and liquidity. So if we look at the point to return, that is with what generally investors try to make the investment is, you always need a return, that is positive return. This is why the objective is being created. Then comes risk. With every return, additional return, there comes a point of risk. So either it is calculated as standard deviation or beta in various cases. So when there is risk, so when there is return, there always comes risk. That is the uncertainty associated with the amount of gains that you are going to get in future. So suppose you invest in equity shares, the price may go down. That is the risk associated with the instrument. Then safety of principal, that is how long or for what amount of period, or whether the amount that you have invested is in safe hands or not. So it is like very it's generally advisable to not invest in chit funds. So because it's not very safe, because it will be very prudent enough to invest in a safe instrument like a debenture or bond. Then NSC, like National Savings Service, if you invest there, there is no default risk. So your amount that you have invested will, you will not lose that. You will, at the end of the maturity, you will definitely get back the amount. Then liquidity. So liquidity is the nature whereby the amount that you have invested is converted into cash immediately. So you need to understand for how long do you have made the investment. If you have made the investment, suppose for 5 years fixed, if you deposit a term deposit, then it is not possible on your part to withdraw that amount. Similarly, is the case of PPF, that is Public Provident Fund. The Public Provident Fund matures at the end of 15th year. So nowadays it is allowed after 6th year, it is allowed, a partial withdrawal is allowed, but you cannot withdraw the entire amount, the amount that you have invested in PPF. So liquidity also matters while making an investment. Then duration. So duration is the amount, or is the time duration for which you are investing. So some like mutual funds which have tax shelter, like ELSS, equity linked savings scheme, there is a lock-in period of 3 years. You cannot withdraw the amount before 3 years. So it is said that once you invest in a ELSS, at least for 3 years, you need to forget about it, because you cannot withdraw from it. Then there is one more point, that is called income stability. Like here it has been mentioned, whether the returns that you are expecting, is it stable throughout, or it is fluctuating, or is it volatile throughout their investment life. So if it is stable, it is more or less good. But for some people or some investors might think of, if they are risk takers, they will be investing in such a place where the returns are volatile or not stable. So it depends on the views of the investor with which they are making the investment. So these are the characteristics with which investments are made. So with this, we come to the end of this class. Thank you so much.